Delta Neutral Funding Rate Farming, war the title. Welcome to another video. My name is Kügi, and as always I try to provide you with data and insights so that you can make smart decisions for yourself. Today I want to talk a bit more about this funding rate strategy that I started in a previous video where I talked about this 60% APR on USD strategy. Because after this video, I got the feedback that some of you, especially some newer followers, hey Bernie, have absolutely no clue what I'm talking about. So I thought, let's do a video about a bit of the basics and give you some ideas, maybe add some more information on that. And after that, we will look at the state of the position, where it is, and especially with this more insights, it will be a bit more clearer what's happening there. So, delta neutral funding rate farming. To talk about funding rates, I think we need first to establish a bit of an understanding about futures. And futures, yes, some know it from the crypto market, but they are actually an old trading tool or old thing in the financial industry. And where do they come from? If you think about farmers, and that's the old example that I think everybody uses to explain futures, so I use it too. Let's think about a potato farmer. If you go to a farmer's market, you can buy potatoes. You give them dollars, they give you potatoes. You buy the potatoes on the spot there. And that's where the name spot trading comes from, because you can have spot exchanges where you buy stuff and you directly get the stuff that you buy. You have to give them the full amount in dollars and you get the full thing that you buy, like with potatoes. Now, a potato farmer has stuff that he sells right now, and he also has his field and everything where he grows potatoes. And he knows he will have a lot of potatoes in August, for example. And he now has a lot of expenses to pay right now, fuel and everything for this growing the potatoes. And he would be happy if he knows that he will be able to sell those potatoes in August at a certain price, because then he can calculate how much he can now spend for stuff so that he's still in a profit. And on the other hand, you have people who uses potatoes, for example, a restaurant owner, and they know people will eat potatoes in my restaurant in August, and I will need potatoes in August. And I want to know how much I have to pay for the potatoes so that I can put up my menu prices and everything. So he would like to have a fixed price for his potatoes that he needs to buy in August. So he now goes to the farmer. So we have the farmer on the I want to sell potatoes. We have the restaurant owner on the I want to buy potatoes. And they agree, so they make a contract about a trade in the future, a so-called future contract. That's why I trade futures. So a contract about the trade in the future, about a fixed amount, a fixed price, and a fixed date in the future when this will happen. And since it's a contract for the future, the seller don't have to give the potatoes right now because it will happen in the future. And the buyer don't have to give all the funds, all the money right now. But usually you have to put in some safety deposit and say, okay, I put down 10% of the payment that I have to do then, so that everyone is sure that I will pay up when the time comes. Now, this all is clear and makes sense, but it's a bit complicated if you have all potato farmers in the whole market to match up with some restaurant owners and whoever. So to do that in a bigger style, we have the exchanges who match up buyers and sellers and make sure that buyers find sellers, because an exchange, a central exchange, is nothing else than a matchmaker where buyers and sellers come there, and the exchange makes sure that buyers find sellers and you have the match. Spot exchange is the same as futures exchanges. So that's why this came in and how the exchanges came in, or the futures trading, so the futures market developed. And now there is a financial instrument, futures market, and traders decided that's something that we can speculate on, because with a future, you can bet on prices up and down without ever the need to actually hold that thing. Because if you want to bet on a rising stock market, stock price, you have to buy the stock. So you have to find someone to get the stock from. You can't open a position that's bigger than the overall supply of the stock, because you have to buy all the stock. And yeah, you need to buy it. You need to put in the whole amount to get that amount of stock. And if it goes 10% up, you make 10%. If you want to short the stock, so profit from selling the stock from the falling price, you need to find someone that borrows you the stock and then sell it on the market and then buy it back. So it's a bit of things around to do there. In the futures market, it's a bit different, because in the futures market, you just need to open a futures contract with someone. For example, if I now say, I bet, because that's what trading is, I bet that the potato prices will rise by 10% in the next month. Now it's June, so until July, I bet that potatoes will rise 10%. If I now say, okay, I buy, for example, $100 contract, I open a $100 contract in the future, potato future for August, I need to put down, let's say, $10 as a safety deposit. I open a $100 contract to buy, that I will buy potatoes for $100 in August with someone, whoever. Exchange takes care of it. Now, if the potato price in the future rises in the next month 10%, so the price of the future is now 110, I can now take my futures contract and sell that to someone else. Because I can say to someone else, I sell you potatoes for $110 in August, because now the price is at 110, so I will find a buyer at 110. And now I have the situation that I would buy potatoes for $100 and at the same time sell the potatoes for $110, so I have my $10 profit. And since I only put in $10 as a safety deposit, I actually made $10 on $10, so 100% on my invested used capital or used funds. And that's what leverage trading is, because I only had to put in $10, but I traded a position worth of $100. So a 10% profit is actually for me 100% gain on my position. And that's a nice thing about futures. It now just opens the possibility to trade and speculate on a price of the underlying asset, where you can trade with leverage. You don't ever have to hold any of that stuff. So even if you sell, if you want to bet on a falling price of potatoes, I can now say, I sell you potatoes for $100 in August. And if the price falls to $90 in July, I buy it back for $90. I make again the $10 profit, but I never had anything to do with potatoes. I don't care for the potatoes, just for the price. So that's what the traders do in the futures market. You can trade with leverage, and you can bet on rising and falling prices, and it doesn't do a difference in the mechanics behind it. So that's the interesting thing about the futures. Now the question is, why is a future price connected to the spot price at all? Why is it not some arbitrary number? Because I can trade and do whatever. And the fact is, sometimes this happens, that if the August future can be traded in June at a massive premium because people speculate on it. Sometimes that's a problem. You hear it in the markets, in the news sometimes, that the traders, speculators mess with the food prices or something. So there's that. But that can happen. But at the settlement date, the closer it gets to the settlement date, the closer the futures price goes to the spot price. Because if we say on 15th of August, the future settles. So at that time, the contract needs to be fulfilled. And now it's the 14th, and the spot price is at $100, for example, and the future is at $200. Now, I could say, I now buy potatoes for $100 on the spot price and open a future contract as a seller to say, okay, I sell you the same potatoes tomorrow for $200. because the future price is now $200. I make an instant profit of $100, and therefore I would definitely do that. And that creates sell pressure on the future, so the future price will go down because more and more people open the sell position. And if you remember what we did with the strategy, that's exactly what's happening there. But spoiler alert. So that's why the future price is connected to the spot price coming to the settlement date. Now, what does that have to do with our crypto position? Well, one thing to keep in mind before we go that further is you have the contracts, and since just one observation basically, for every contract you have the same volume in buy and sell positions, because the contract says I sell you one potato. So one potato sell and one potato buy. If you sum that up, you have all the long positions, because the buyers are called long positions. I don't know why. The sellers are called short positions. And if you sum that up, you have all the long positions that bet on a rising price and all the short positions that bet on a falling price. And that sum is the open interest. And that sum, since every contract has the same amount left and right, that sum also equals up. So you have the equal volume in long and short positions, and that's called the open interest. And the open interest is a number that shows you how active the market is, how much interest is in this market, because how many contracts are open basically. And you have that same amount left and right. Now, what has that to do with our position in crypto and everything? Well, when crypto came along, in the beginning, only Bitcoin, and people wanted to buy and sell Bitcoin. And the traditional exchanges didn't care for that, so we came up, or the industry came up with also exchanges, crypto exchanges, non-regulated, just crazy stuff on the internet where people could buy and sell Bitcoin. And they got more and more sophisticated, but it was still spot Bitcoin, right? So you bought Bitcoin, and if you put in $1, you got back Bitcoin worth $1. Just normal spot trading. And then the exchanges got clever because they found out, basically, or realized that the people, some of the people don't care for Bitcoin at all. They just care for the prices, and they want to participate on a rising price. So they want to profit if Bitcoin goes up, and Bitcoin got up a lot, so people want to get up a lot. And they said, okay, what can we do that people can start speculating on Bitcoin without ever having to hold Bitcoin and without ever having to move Bitcoin around and just speculate on it. And that's where futures come in, because as we said, futures is a way to speculate on a thing with the possibility of leverage, depending on what margin requirements you have, and without the possibility to speculate on falling prices, without ever to have to hold Bitcoin, and on rising prices without ever getting Bitcoin, because you just buy and sell the future, and that's it. And now the thing was that most of the crypto traders are not real professional traders who know about the stuff and want to know about the stuff. They just want to get rich, and they want to get rich quick, and they want to get rich quicker with more leverage. And in reality, that often means that they get broke quicker, but that's a different topic. Now, the exchange thought like this whole settlement thing with futures and have different futures for different settlement dates, far too complicated for this average gambler. So let's create something new, and let's call it a perpetual future. Perpetual future, which actually means it's a future that runs forever. So you don't have to care about the settlement date. You don't have to care about anything of that. You just use all the nice features from the futures trading with leverage, with opening buy and short positions, no matter what, and do that without caring for the settlement date. Now the topic is, as we said before, the settlement date is what keeps the future price in connection with the spot price over time. If you have no settlement date, or the settlement date is in the infinite future, well, then there is no connection. And that's why they came up with this funding rate. You can on the one hand call it now a future that runs for 8 hours and then automatically rolls over to the next period, but that explanation is a bit more complicated than just saying it's a funding rate that the funding rate keeps the perpetual future price close to the index price. And how does it do that? We already said it's left and right the same amount, and the funding rate is just a payment that the long positions have to pay on their position to the short positions. So long positions pay to have their positions open, and short positions get paid to have their positions open. And the funding rate, a neutral funding rate, is usually 0.01% every 8 hours, which adds up to around 10% APR a year. And that's what, on average, in the neutral case, so if the price of the future is close enough to the index price, to the spot price, then long positions have to pay 0.01% to the short positions. This imbalance is because there is usually more people betting on rising prices, and usually prices rise. So you have to incentivize people for opening short positions and disincentivize people open long positions, because they anyway want to open long positions. That's why the neutral funding rate is positive. And now you have that funding rate. And if the future price goes up a lot, so it's above the index price in a premium, then the funding rate gets bigger and bigger. So it gets more and more expensive to have a long position open, and more you get paid for having a short position open, because the funding rate goes up. So the long positions will close their positions because it gets too expensive, and short positions will get opened, and therefore you have sell pressure on the future, on a perpetual future. Price goes down closer to the spot, and you have the effect that you want. If the future price is even below the spot price, then the funding rate can get negative. It's rare, but it happens, especially in panic selling. If everybody bets on further rising or falling prices, then the funding rate usually gets negative. So the shorts actually pay for having shorts open, and the long get paid because it's so much far down that you need buy pressure on the perpetual future. So that's the funding rate. And now that's the thing that we want to profit from. And how do we profit from a funding rate? Because if the price goes up, your short loses, right? So what do? That's the strategy. We as a trader, take $100 and we buy Bitcoin. In my case, when I opened the position, it was exactly that this $100 were worth 0.0143 Bitcoin. Now I have this Bitcoin, and I'm now, open to any price change on Bitcoin. If price rises of Bitcoin, my position goes up. If price falls, my position goes down. But I don't want that. I want to just earn funding rate, right? So I take that Bitcoin and I use it as a margin, the safety deposit, to open a perpetual future short worth $100. Now I have a long position, or an open spot position that profits from a rising price, and a short position that profits from a falling price. So they cancel that out, and I earn funding rate on this perpetual future, on the short, because I get paid the funding. If the price is in a premium, I even get higher funding rate, and therefore I earn. Since I put in $100 and I opened a short position worth $100, I earn my funding rate directly on the $100, so I can directly take that as the return that I get on my invested funds. And the short cannot get liquidated because I cannot run out of margin, because my Bitcoin that I have as margin is exactly the same amount, same worth as the short. So I use that, and I cannot have too low balance in the account, because the balance goes up if the price goes up. Now, why is this called delta neutral? And that's the thing that you have here. Delta neutral, basically, if you have a delta, so a difference in the Bitcoin price, is this good or bad for you? And in this case, if the price of Bitcoin goes up, our spot position is in a profit, but the perpetual short loses the same amount that the spot position gained. So the delta for us, we are neutral because we don't care. We stay neutral regarding the Bitcoin price. Same if it goes down, spot position is in a loss because the Bitcoin is now worth less, but the perpetual short wins. And again, this cancels out because it's the same value. And therefore we have this again neutral. So we don't care for the delta of the Bitcoin price. So we are delta neutral in the Bitcoin market. And generally a delta neutral position doesn't make sense in this case, in this term, when you have the same amount of long and short, because why do you open a position like that if you don't gain anything from a price change? And that's because from some other mechanism, from some other delta, you make a profit, in this case, the funding rate. So you have a delta neutral position, which means you don't bet on the Bitcoin price going up or down. You don't care for the Bitcoin price going up or down. You just use mechanisms, or you bet on something else. And in this case, we bet on a positive funding rate, and the funding rate that's higher than any interest rate that we get somewhere else for our $100. That's basically what this bet is on, that we have a high funding rate. And as soon as the funding rate gets too low or even negative, we can close the short, pay back, so sell, so we don't need the margin, sell the Bitcoin, and that cancels out, and then we're out of the trade. So that's the theory behind it. I hope this was not too much theory, but still you got what I was talking about, because now we look into the current position that we have open here. If you don't remember, watch the other video. I opened, I think 9 days ago, I opened this position in, it's, as I said, on Bybit. I opened this position where I bought on the spot market $100. It failed only 99.95, but yeah, never mind. So I bought $100 of Bitcoin. It was 0.0143 Bitcoin that I bought, and I used that and opened a perpetual future short position, quantity 100 USD, worth 0.014. There should be a 3, but it's only 4 digits. And yeah, this is the position. We opened it at fair price at 69,897, and the short got opened at 69,903. So you see there was a premium of $6 when we opened it, or we managed to get a premium of $6. And one important thing to note now, if you look at the current price, we have 270 versus 330. So there is now a $60 premium in the perpetual future. Also explains why the current funding rate is still at 0.032, which is above 30% APR right now. Also interesting, right now the premium is a bit higher, or clearly higher than it was when we opened that, but when we opened that, the funding rate was at 0.05. So it's a bit difference, not directly connected to the premium, but a bit of the premium over time. So keep that in mind. Now, we have this position, and if you now look at it, when we say we would, let's take the current price. If we would sell this 0.0143 Bitcoin at the current price on the market, we would get $101.9. So we gained $1.9. At the same time, the short position has an unrealized profit of minus $2.04. So, and this is now the difference because of this premium, because we have $70 premium right now. We have more loss in the perpetual future than we had gain from the spot position. But that's the thing, that as long as we have a premium in the future, we do not want to close that, because a premium in the future means we get funding rate. So anyway, we don't want to close it in premium. We want to close this position when the premium is gone and the funding rate is either neutral or even negative. So in best case, we will close that position when the perpetual is in a discount, and then we make a profit from this difference, and even had the funding rate till now. And the funding rate till now, that's the realized, on Bybit it's shown like that, it's a realized profit till now of this position of $0.3. On a $100 position, that means 0.3% in 9 days, which is around 12% APR. So you see, in the meantime, because when we opened it, I think somewhere here, we opened that, right? And, or was it here? I don't know. Somewhere in that area. And there was a lot of, back and forth, and it went down a lot, down. And in that time, we had neutral funding, and therefore over time, and from this realized profit, it's already the fees from opening the position is already subtracted from that. That's why we don't have the super high yield there, but only 12% APR so far. And now at the next funding rate in 3 hours and 50 minutes, we will get 0.03% again. So it will go up to 34 USD realized profit. So I hope that explained that a bit. Also, this is the update. As I said, I will keep that open and we see where this is going. I will do an update once something changes, or just in a few days, to have an update there. So with that, I hope this explained a lot. If not, leave a comment, tell me what you think about it, and with that, see you in the next video.